Hi guys, this is the Direct Investor sharing tips and tricks to make your financial day-to-day a bit more comfortable and easier to manage. Today we're talking about understanding basic types of bank accounts. So there are three basic types of bank accounts. We have a transactions account, saving accounts, and term deposits. And with most of these ones, well, especially the transaction account and savings account, they can be broken down into subcategories. So let's go have a look at them in a little bit more detail. So in the transaction accounts, these ones are generally your day-to-day accounts, the one that you use with your key card or your debit cards. So generally in Australia, we have two types of transaction accounts. You have one that's a limited transactions or services account, so you pay a smaller fee, but may restrict the amount of transactions you can do over the counter or using an ATM. The second one they have is an unlimited, and for a little bit more money you get unlimited transactions over the counter or through the ATM. So generally both use your debit card or key cards, and these are the accounts that you'll be getting your money out of when it's not being saved, put into a savings account. Again, using it at the shops or using it when you buy online, when you're using the debit card, this is the account that the money will be coming out of. So when the money is not in the transaction accounts, they'll look at going into a savings account. So savings account have a more interest on these accounts. So they're generally, with a savings account, they're online, and because they're online, they don't require the bank to have so much maintenance. So someone's there servicing or having to do transactions for you. So that's why they generally have no minimum balance requirement, no account keeping fees, and generally you can make access to them. You can have access to them 24/7. So in the flexible, as we were just saying, there's no minimum balance, no account keeping fees. They're all online, so you can make unlimited transactions there as well. They're quick and easy to make transactions in and out of, and interest is calculated daily but paid monthly. So these accounts have higher interest than your transaction account, and so you keep your money here. Generally, with a flexible online account, you keep money in there for your short-term goals, money you may be using in the next month or so. Alternatively, if you're having bigger goals, you probably look at doing something like an goal-oriented account. So these ones here, again, have no account keeping fees. Sometimes they're online, sometimes they're not. But you have to limit the amount of transactions in these ones. So you may not be able to make withdrawals without compromising your bonus interest. So with these goal-oriented accounts, if you deposit a certain amount of money each month, for example, some institutions may say you need to deposit $50, and make sure you deposit that $50 without making withdrawal. They may pay you what's called bonus interest. That means that they're encouraging you to save, that the maintenance there doesn't require you to put so much in there, doesn't require you to do many transactions in it. It's a really good account if you're looking to save money over a longer period of time, say for a home, or you looking to buy something of greater value in money sense. So these accounts, goal oriented and flexible, have a higher interest rate than your transaction, and generally this is where your money will be stored if you're not planning to spend it in the near future. The last of these three accounts is the term deposit. Now the term deposit is generally for money you're locking away. It's a really good investment if you have difficulty saving money and not spending it. These one actually locks it for a predetermined period of time. So again, with the term deposit, there's generally no account keeping fee or management fee. They're a secure investment. By that I mean you don't have much risk because you've entered into a contract with the bank. You already know the predefined return that you're going to get from that investment. Um, with the terms, you can start as low as 2 months, but generally most institutions have a better interest rate starting from about 6 months to 5 years. Unfortunately, with a term deposit, or fortunately, depending on how you look at it, there is no withdrawal of funds without paying a hefty fee. So generally, it's a good deterrent for people who are looking to put money away for a while. Also, it stops people being able to spend it. So it's a good in that sense, but it also means that you're looking at that interest rate. So if they do go up, you have to wait to the end of the term or break it, pay that hefty fee to break it and reinvest it. And interest can be calculated daily or can be calculated using simple interest. It really depends on what option you choose at the financial institution. So guys, those are the three types of basic saving accounts. If there are any questions, just drop me a comment below. I'll get back to you as soon as I can. And that's all I have for today. So remember, if you have remember all of these strategies here I've shown in this video, don't consider your personal circumstances. Should you want to change your investment advice, make sure you seek a professional financial advisor before doing so. Alright guys, I'm the Direct Investor and I'll talk to you soon.